Well, a warm welcome to all of you, and especially Mr. D.K. Agarwal, Indorama Ventures Deputy Group CEO. Thank you for joining us, sir.
Thank you for having me this way.
Well, a few days ago, Indorama Ventures reported its third quarterly earnings for 2023. Now, that was a relatively stable result, with EBITDA rising 1% from the previous quarter. Mr. Agarwal, before we get into the macroeconomic influences on the results of indeed the last few quarters and talking about the outlook, obviously, for the forthcoming year, what were the key standout metrics of this result for you?
I think it has not been very great results, to be fair, that we just made $324 million EBITDA, which is 1% growth. The market has been very, very challenging. The only positive part is the management actions which has been taken on the cost reduction, particularly on Olympus, where we have registered $500 million run rate, and the operating cash flow of $420 million. But it's a difficult time. The chemical industries are passing through that. The destocking has not really come to an end. And what we really see is that, particularly in CPET, which is our major segment, we saw a very record low margins, which we never saw in the industry. And that happened because of significant build-up of the capacity in China. We're getting some news that 4 million tons of PET capacity has been temporarily shut down in China, which should help a little bit in the margin side. Too early to say. Similarly, IOD downstream, the destocking in crop solutions has been going. So that has been also had a very compressed margin. So I think this year is sort of a wash. I would say fourth quarter will be still challenging. But I think 24, as we go forward, our robust platform is there. We did improve our working capital significantly. We reduced the gross working capital by 13 days by aggressive actions. We reduced our capex by $240 million. But there's a lot to work to do. And I think management is taking all the actions. And I think my colleagues around the world are going to work towards it. This time will make us more stronger.
Well, let's talk a little bit more about those management actions in perhaps a bit more detail. You have already touched on the very challenging time, indeed, not just for us, but the broader chemical industry and some of the drivers of that. But what specifically can we do as a company, and what have we been doing to take us through this challenging period?
So cash is king. The cash conservation is the most important. We targeted in Capital Market Day about $500 million. We're already achieved 92% in terms of capex reduction and working capital reduction, which I talked to you 13 days. We'll remain relentless focused on cash conservation. As a part of that, even our partners together, we posed the construction of Corpus Christi project, which will also reduce the capexes going forward. So second important part which we are doing is footprint rationalization. Europe is very, very challenging. We announced about the footprint rationalization of fiber business, which we are on track at present. Those aggressive steps are being taken. We also announced actually in CPET mothballing of our Portuguese asset, which is going to reduce the fixed cost by $17 million per annum. And we are having a very strategic look at all of our asset portfolio, what exactly we can take action on footprint rationalization. Doubling down on Olympus, we're going to launch Olympus 2.0, which will be unleashing the value of SAP HANA 4, digitalization, value pricing, which may probably unlock $400 to $500 million. So this is a time to make company more stronger than ever in terms of reorganizing. We are reorganize the fiber, collapsing the three verticals into a market-facing structure. So all those actions are being taken, including refinancing. We have refinanced a good part of our debt of 224 and focuses on interest cost to bring down. So whole is free cash flow. Today we have generated $57 million, but going forward, how to keep deleveraging the company.
A bit earlier, you mentioned two key drivers in particular of the challenges to the industry, and that was the ongoing recovery in China, which is somewhat slower than expected, and also this quite unprecedented trend of destocking. Where do you see those two particular factors, and indeed any others, as we look to the next 12 months ahead?
So let's talk about China. I mean, China, we thought that youth saving is there and there will be revenge spending, and we'll see lot in manufacturing coming back, but PMI has just marginally improved, but October it reported lower. Service industry reported better. So China has been a disappointment actually as it opened up post-COVID. Recently, Chinese government has put a stimulus message. The housing crisis is one of the major crises, and I believe this will create some demand upliftment in the Chinese domestic market, which should help in the overall chemical industry. Destocking has been very significant. Actually, we did not expect that it will linger on, and probably none of my industry peers, because when we look at this is an entire value chain stocks, inventories around distributors and customers, and the interest rate increase has a significant bearing on that, because so far the interest cost was zero. So people were not worried about the carrying cost. But today now all the CFOs of the world are talking about the interest cost. And that's why the entire inventory got liquidated, supply chain got normalized. So it's in process of that's what is happening. We saw in fabric, apparels, but we don't see the end demand destruction. When we look at the brand owners, Pepsi's or Coke's results or others, they have shown improved earning, and volumes has not been more or less flat or slightly down. So this is very encouraging that about 70% of the portfolio is very resilient, and it will also maybe force some rationalization in the world of certain incompetitive assets, and that's what happens in this difficult time.
Well, Mr. Agarwal, thank you indeed for giving us that overview of the third quarter earnings, and we look forward to the next quarter.
Thank you very much. It's a pleasure to be.